unquoted valuation of unquoted shares, especially in, for the income tax under section 56. I herewith this is my proud privilege to welcome our today's speaker, Mr. Sundar Raman sir. A few words about him. He is a fellow member of our Institute of Chartered Accountants of India. He almost completed a decade of practice. This is our 12th year of practice. He is in registered valuer for securities and financial assets. He is in qualified information system auditors. He is in specialized area in Indian corporate laws and the Foreign Exchange Management Act. He is right now partner in G. Sekhar and Associate Chartered Accountants, Chennai. In accredited, he is national accredited trainer for Institute of GST Laws, accredited by National Academy of Customs and Indirect Taxes, NASIN, that is Ministry of Finance and Government of India. He is also member of Chennai Citizen Forum. Right now, he is in Erode as treasurer for the period of 20 and 21. He is member of PTA of Padma Sheshadri Bala Bhavan. He is in Higher Secondary School, Chennai. He is a member of Chartered Accountancy Study Circle and Society of Auditors, Chennai. He also co-opted member of Institute of Chartered Accountants of India, Delhi, to the Corporate and Economic Law Committee for the year 2021. He also co-opted member of Southern India Regional Council of India, Corporate and Allied Laws Committee in 2017 and 2018. He is in faculty of corporate laws. We know well-known academy. He is in Guru Giruba Institute of Management in Chennai. He presently the member of Academic Council of MOP, Vaishnavi College of Women, for the period of 1920 as well as the 2021. He is also Board of Studies Management and Commerce Division of Stella College member for the period of 19. He presently Division of Stella College member for the period of 1920. He is also in ICAI branches, particularly in CA inter and final level, and also CNDG trainer and regional, CNDG Controller and Auditor of India, Government of India, and also regional trainer of Institute of Central Board of Indirect Taxes and Customs, Ministry of Finance and the Government of India, faculty for the Corporate Laws and Accounting at MOP Vaishnava College, and also faculty for PG Commerce and Financial students of Stella College. He also public forum speaker in lot of public forums, particularly in GST trade and so on, Dinatandi and so on. In these few words, I welcome today's session speaker, Mr. C.A. Sundar Raman sir. Welcome, sir. Welcome to our Erode branch. Floor is yours, sir. Can you take care of?
Thank you, Chairman. Respected Chairman, Management Committee members of the Erode branch of SIRC of ICAI, all the senior members of the profession, and all the other members, and the participants for the today's CPE seminar. At the outset, I thank for giving me this wonderful opportunity to share my knowledge on today's topic on issues on the valuation front, with respect to more particularly on the much debatable issue which is going on under Section 56 of the Income Tax Act 1961, with respect to valuation issues under the, more particularly for the unquoted equity shares. I also take this opportunity to congratulate the excellent team under the leadership of Mr. Balmurugan, the chairman of the Erode branch, for taking effort even during this pandemic. Despite during his chairmanship, I think a substantial period was suffered a lockdown, but I think he's taken up this as a challenge, and then organizing various the programs through the under the electronic the E segment through the Zoom and other things. I also having been a good friend of mine for over a period. I'm very happy to also see him as the chairman as well. With this little the introduction, I straight away get into the topic. Wherever there are questions, probably I would share the part on the explanation on the first segment, and thereafter down the line probably we can have a separate the Q&A session there as well. Now, generally, while we see that evaluation of share as such is, there comes a question as to whether it is an art or whether it is an the science. Lot of interesting things which are happening and developing around. I'm sure everybody would have been about a concept called as registered valuer under the Companies Act. Many of you probably would be attending for the exams also to qualify as a registered valuer. More particularly, people who have done the IBC exams, the Insolvency and Bankruptcy Code exams, they've also made an attempt to write this particular the registered valuation exams, which is presently monitored by the Insolvency and Bankruptcy Board of India itself, where a chartered accountant with 3 years of practice can write the exams, unlike an IBC, which requires 10 years of practice to write the IP examinations. Now, down the line, there has already been a draft valuers bill which has been in place, and soon we are going to have something called as a Valuation Board of India, which will be in place, which will regulate the profession with respect to the valuation separately. Just like we have the IBBI, we have a separate Valuation Board of India. Presently, where there are some challenges that even under Section 56, for the purpose of discounted cash flow, for example, there has been a sudden surprise notification from the CBDT, where withdrawing the certificate which a chartered accountant can issue for the purpose of discounted cash flow method under 356. No longer, they said only a merchant banker can issue, because some sort of huge dilemma was happening on the overboosting of shares, more particularly in case of the startup companies, where 10 rupee shares has been quoted at 1,000 rupees, 10,000 rupees, some cases even 20,000, 50,000 rupees, also huge and exorbitant amount of premium. So the income tax departments were actually under the income tax law, there's never been a concept of technically, generally at the outset, taxing the capital receipts at first place, where 10 rupees shares a company issues at, let's say, 100 rupees, 90 rupees being a premium, which goes and sits in your books of account as a securities premium. It's technically a capital profits. So there's been no provision to tax the capital profits at the first place. But the income tax department were raising the eyebrows when a lot of companies' valuation, more particularly the startup companies' valuation, they are able to get raise equity and raise funds. Huge exorbitant amount of business valuation they have done. And there are many people who do business nowadays, even just for a valuation game. And at the end of the day, there will be a losses as per the balance sheet, but then they will say the business valuation is huge amount. 10 rupees shares, they will value at exorbitant 100 times even of the valuation. So these profits, which are sitting in the books of accounts, the balance sheet, the department thought why we should not be taxing that, why the security exorbitant amount of premium should not be taxed that. I accept a reasonable the premium. In fact, if you see, even under the provisions of the Companies Act, if you read section 52 of the Companies Act, which talks about the issue of shares at premium, there is no restriction on what is the maximum amount of premium a company can charge. The governing law for the purpose of issue of shares is this Companies Act. There is no restriction on 10 rupee shares can be issued at a premium of only this much. Earlier, under the 1956 law, Companies Act, we had a provision that a company cannot issue shares at discount of more than 10%. Now, under 2013 Act, issue of shares at discount itself is void. You cannot issue shares at discount except in case of certain debt restructuring, sweat equity, etc., where you can still issue shares at the discount. So, meaning which there is no maximum amount of premium which you can charge that has not been specifically regulated under the governing law, the Companies Act, at the first place. Having said that, even in case of listed companies, the merchant banker and the issuing company basically are required to disclose in the financial statements the justification for the amount of premium. Even if I'm issuing my shares at 10 rupees shares at 500 rupees or 600 rupees, exorbitant amount of premium I'm collecting, there is no ceiling limit on this is the maximum amount of premium you can collect. That is based on some judgmental analysis done by the merchant banker, but I need to give only a justification. If I can give a justification, there is no harm on what is the maximum what you can collect. But that is where all going on. The income tax guys thought that, okay, sitting at while we will try to make something called as a fair market value, they made an attempt to establish something called as, let's define what is the book value. Let's define something called as what is the reasonable value. Because in case of quoted shares, based on the performance of the shares, performance of the company, the share value is being determined on the basis of the demand and supply in the stock exchange. So on that basis, on that particular value where the deal can, the purchase can, the sale issue can take place, we have some sort of a reasonable price mechanism to know. But in case of an unquoted, though the definition of the income tax law for unquoted shares is very wide, for the timing, let's understand that it's at first place unlisted. So an unlisted shares, unquoted like private company shares or an unlisted public limited company shares where it is not being traded. So what is the fair value which need to be determined? So a 10 rupee shares, let's say they are giving a formula for the purpose of determining the fair value of the share is 100 rupees. Okay. 10 rupee shares, the fair value as per the formula which is given by the department seems to be 100. That's fine. In case you are issuing and collecting any amount more than 100, you are issuing shares at premium, but above fair value also. You are issuing, let's say, 10 rupee shares at 150 rupees, while the fair value is only 100, not the face value, fair value. Face value is 10, fair value is 100, but the issue price is 150. That's where the department thought, with it 50 rupees, the excess amount which you are collecting over and above, the excess amount which you are collecting over and above the fair value, the reasonable marketable value of the company, I am going to tax it, that is deemed as a gift. So they Murva share, you are issuing it. So that 50 rupees I'm going to deem it as a gift. So the income from other sources, it has to be taxed under section 56. They have brought in the provision. So there has been a left, right, center. There has been a huge hue and crisis because a lot of startup companies they have issued, because the startup company, many of them generally know how the valuations have been worked out. They only first to talk about what is the dilution we can really work on. So they invest as the promoters will have a small thin capital of 1 lakh rupees and 10 lakhs. They get 20 crores, 50 crores from the investors, and still they will be diluting only 10% or 15% its stake. So out of I'm going to still keep a capital, equity capital less than exorbitant amount of premium, then only I can dilute lower amount of stake in the company. So they fix a percentage and then they do a reverse work and then try to determine what is going to be the value which works out for the given the dilution of the shares. So other mari the department under their such policy, they worked out that there must be some mechanism of regulating the shares, and also left, right, center, of course, even under the accountants who are permitted to do the valuation also, at left, right, center, they have done the valuation. And that's the reason where today we are facing the huge detriment that a discounted cash flow mechanism for the income, for the purpose of income tax, a chartered accountant cannot do. But having said that, when the draft valuers bill, where they are going to make all the valuation under various law, valuation under the FEMA, valuation under the Companies Act, valuation under the IBC, all the value they are giving a list under the draft values. In the valuation there has to be a registered valuer. They are trying to bring and regulate this particular provision. So with this, the outset and the introduction, we will I will start with my slide presentation, and then I will take it up one by one. So as I said, the valuation is it's a completely art. We cannot say that by way of a formula. Well, income tax presently tries to establish a formula and then try to win, because while traditionally 1990s and things like that, even if you read some of the Supreme Court judgments have come across where net asset value, dividend yield method, and some cases 2-3 methods put together, the average of that was considered to be a value. Somebody goes for operational mismanagement to the court of law, the price at which the minority stake is required to be bought back, the Supreme Court generally considers an average of the net asset value, the yield method, the dividend yield method for the purpose of the valuation. And that there come the concept of valuation called as the discounted cash flow, which is where the entire the possibility of challenging and issues revolving around the valuation have actually started. Where the valuation, in fact, has to be, somebody has said it has to be on a what do you call it, futuristic the business model. So there is something called as cost, there's something called as a price, and there's something called as a value. These three are completely different, right? Cost is, let's say, manufacturing a product. Price is what you pay, as the Warren Buffett rightly puts. Price is what you pay. Value is what you typically get. So how do you estimate a value? For example, even in my class session with the students, I used to give this example jokingly. Let's say I wanted to sell this pen to somebody. So I tell my student, so this pen is used by Mahendra Singh Dhoni. How many of them would like to buy this, and at what value? One will say 1 lakh, another will say 2 lakh. And if I say, for example, if the same case, if the heroine's famous heroine's name, actor's name, in fact, the price may sometimes even go up. So the price of this pen may be 100 rupees, but then the value which the person would like to actually associate with this pen, because of the fact that it is being used by X, Y, Z, etc., they are ready to get huge amount of value. So it is therefore what is very important is when you are trying to make an attempt to establish a value of a share, a lot of factors, there is no fixed specific formula for, though the broad principle is there, a lot of specific factor relating to the situation has to be considered for the purpose of the valuing a share. Just like, for example, while buying the house property, let's say there is a lane of immovable property. Front load property, pinadi property. So road side property, generally you will pay more amount of premium, exorbitant. But this pinadi அந்த வீட்டுக்கு பின்னாடி இருக்கிற ப்ராப்பர்ட்டிக்கு கொஞ்சம் கம்மி பிரைஸ் தான் கொடுப்போம். ஏன்னா அது உள்ள போகுது, ரோடு சைடு இல்ல, வேரியஸ் ரீசன்ஸ் கொடுக்குறோம். ஈவன் தோ பை சைஸ் எல்லாம் ஒரே மாதிரி இருந்தா கூட. ஸோ அதே மாதிரி ஒரு கம்பெனில வந்து எக்ஸ் லிமிடெட் அப்படின்ற ஒரு கம்பெனில ஒரு 1 lakh ஷேர்ஸ் விற்கிறோம். சேம் சிச்சுவேஷன்ஸை ஒய் லிமிடெடும் அப்ளை பண்ண முடியாது. Who buys it, who sells it, under what circumstances you are selling it, these are all some factors also which you need to consider, apart from a traditional the pricing formula which you are going to actually use for the purpose of the valuation, right? So as the one of the very world famous called as the valuation guru, Ashwath Damodaran rightly says, valuation is neither art nor science. It's a craft like cooking. You can't learn cooking just through by reading the cooking books. So you need to really practice. So same cases, based on the formula-driven approach, valuation cannot be done. You need to really get into that and then go by situation specific and then trying to establish what is the real value which you can pay, considering the fact that the efforts which has been put by the promoters over the period, and also what is the future expectation of the earnings from the given company should also be considered. Now, we can talk about the valuation under various segments. We can talk about valuation under the Companies Act. We can talk about valuation for the purpose of FEMA itself, Foreign Exchange Management Act. We can talk separately. So today, the scope which we have taken is the requirement for the valuation discussion with respect of unquoted equity shares, the issues revolving around the Income Tax Act 1961. So basically, I would like to the split or categorize the discussion into two parts. Category 1 with respect to issue of shares, category 2 with respect to transfer of the shares. Now, this table will summarize what the broad picture with respect to what are all the various the challenges with respect to the evaluation and requirement with respect to valuations under the Companies Act. More particularly, let's take with respect to unquoted equity shares. Or existing company, all of you know that whenever an existing company, whenever they go for an increase in capital, subscribed capital, Section 62 comes into picture. It says that first right for subscription should be given to the existing shareholders of the company. Whenever a company issues the shares, they increase the subscribed capital. The first offer should be given to the existing shareholder, what we call it as the rights issue of the shares. Now, 62, where there is no requirement with respect to the valuation for the purpose of the rights issue. Even under the, for example, under the FEMA, Foreign Exchange Management, there is no requirement of that. But however, you need to ensure that under the, when FEMA comes into picture, when the shareholder happens to be a non-resident. Only one thing which is required to be ensured is the price which is issued for the rights issue price which is issued to the non-resident shareholder should not be less than the price which is issued to the resident shareholder. That's the only requirement with respect to and the Foreign Exchange Management Act, RBI compliances, which is there in column number 2 with respect to the rights issue of the shares. And in respect of private placements, which is regulated by 62(1)(c) of the Companies Act, very clearly says that whenever you make an offer of share to a set of identified group of people, that is not may not be to the existing shareholder, it can also be to the existing shareholder, but not a rights issue identified specified group by passing a special resolution in compliance with section 42 of the Income Tax Act, you make a private placement. There is a specific requirement under 62(1)(c) that must be issued only at a price determined by a registered valuer. It must be at fair value. 62(1)(c) says if it is issued to an outsider, if it is issued not as per, you are not making not a rights issue directly to an outsider, you must compulsorily issue the shares at fair value, and the fair value must be made by registered valuer. Again, the registered valuer means you need to go and refer section 247 of the Companies Act. And in the under FEMA, where meaning which what needs to be the value? They are saying the value under 62(1)(c) can be any method which the registered valuer feels like best to fit under for the purpose of the 62. But in case where you are making a private placements and then the shareholder happens to be a non-resident abroad, foreign, they are there, then they are making an investment. In which cases, the FEMA says under the TISPRO rules, what do we call the transfer or issue of securities to a person resident outside India under the FEMA regulation, they are saying the shares needs to be issued as per the internationally accepted pricing methodology. So we have the international valuation standards. So we can issue the shares either under the book value or under discounted cash flow, capitalization method. We have various the prescribed methods. Any internationally accepted pricing methodology, that method we can use for the purpose of determining what is the evaluation. Again, presently the FEMA regulation does not say that it has to be done only by a registered valuer. For the purpose of FEMA, even a chartered accountant can do an evaluation who is not maybe a registered the valuer. Now, again, for the purpose of now coming to the income tax law 56(2), whenever there is an issue of shares, where particularly a private placements, etc., whenever there is an issue, you need to issue the shares at a fair market value. The method of valuation is given under Rule 11 UA2 of the income tax rules, which broadly gives you only two options. Either you issue at the book value, and for the purpose of determining the book value, they have given a formula, specific formula, nothing but basically an assets at prescribed rate, asset minus the liabilities is what generally book value. What are all the assets you should take, what are all the liabilities you can deduct is what they are giving. Or the book or the discounted cash flow. See, if you wanted to determine the value under the book value, probably which could be less. For example, at 10 rupees face value shares, the book value of the company, just like assets and liabilities, if you add, could be, let's say, even 60 rupees or 70 rupees. But you may wanted to issue the shares at 200 rupees or 300 rupees at an exorbitant premium. That is where you wanted to actually go and prove the exorbitant amount of premium by saying that's the fair value by adopting what is called as the discounted cash flow method. And you need only a merchant banker presently for the purpose of income tax law. So for the purpose of Companies Act 62(1)(c), they are saying registered valuer. And even a registered valuer cannot do a valuation for the purpose of 56(2). They are saying only a SEBI-registered merchant banker can only issue a certificate, not just a chartered accountant, not even a chartered accountant who is a registered valuer, but only a merchant banker for the purpose of 56(2). And as I said, that is where the organization will take place under the draft valuers bill, where they are permitting all the registered valuers can do the valuation for even for the purpose of the 56. Now, with respect to transfer of shares, as we discussed about issue number 1 on the issue of shares, and issue number 2 valuation requirement with respect to transfer of shares. Under the Companies Act, the board is required to facilitate valuation. Usually, an independent valuer will be appointed, mostly in case of an again unquoted shares, a closely held company. The valuation would be done as agreed between an buyer and seller, and board will facilitate the valuation by way of appointing an independent the valuer. Again, for the purpose of in case the transfer happens from a resident to a non-resident, etc., in those cases you need to sell the shares only at fair value, because it involves foreign exchange implications. So accordingly, you can use any internationally, you have to use any internationally again accepted pricing methodology only for the purpose of determining the fair value. Because under the FEMA, 10 rupee shares, if you just issue at 50 rupees, I'm worried. If the fair value is actually very high, I wanted to, under FEMA, actually by allotting the shares, you are creating a sort of a liability. So under the forex liability. So you wanted to issue at a very reasonable fair value. In fact, some of the cases, what happened is, in fact, the fair value, or in one case, the the chartered accountant issued a certificate for a company at some 100 point some 35 as per his exact number. So what we have taken as round number 100. So then the RBI wrote a mail saying that no, why you have taken at 100? It says 100.35. Then you issued only at 101. So because they wanted to prove the real the fair value, because one share of that 0.35 and huge amount of dollars, it says 10 crore dollars coming up, the huge amount of money which is coming up, that would have a big impact. Even that small decimal will have a big impact in terms of the INR in creating a liability. So the RBI is worried about even some small decimals with respect to the issuing of the shares. And as far as the transfer of shares, where the 56 to 10 comes into picture, they're saying it should not be less than the fair market value under Rule 11 UA1, where they're giving only book value. So for the purpose of transfer of shares, if you see the mode of valuation, there is no requirement that the fair value has to be benchmarked on the base of the DCF only. So for the purpose of transfer of shares, what the department says is transfer at least at book value. But book value means they are giving a formula here which technically takes into account some sort of an indirect the market value also, which which are all the issues which we are going to really see here. For example, 10 rupee shares, whereas per the formula given under Rule 11 UA1, let's say it comes to 100 rupees. You are selling at more than that, no problem. Because we are actually, for the purpose of capital gain tax, you are offering 120 rupees. Let's say you are selling at 120, no problem. I'm happy. You offer capital gain tax at 120, no problem. But where the problem comes is, where for the purpose of this Rule 11 UA here, or even they have introduced a new section, that 50 CA, where just like an immovable property, like let's say a land, where 1 crore rupees the worth of land, guideline value, you are selling it for only 60 lakhs. For the purpose of capital gain, we will take consideration only guideline value, 1 crore, and then you have to assess for the taxation. Similarly, here, even in respect of transfer of shares, where the fair value is 100, but you are selling at only 60 rupees and then trying to indirectly transfer certain assets and escape the capital gain taxation. That's why they have plugged the loophole by saying, introducing 50 CA for just like 50 C for immovable property. They introduced 50 CA for shares by ensuring that the transfer should also be at happen at fair value, just like guidance value for an immovable property, which is what is sought to be established under Rule 11 UA1. So these are all the various the perspective of the valuations broadly under the coverage of the laws, these three law. And another important challenges which we need to know is the treatment of various types of instruments under this law. For example, if you take Companies Act, Section 62, primarily just Companies Act, the type of shares which we can issue, and the treatment is basically equity shares and preference shares, and you have the preference shares again being classified into convertible, non-convertible, optionally convertible, or mandatorily convertible. That's what you call compulsory convertible, cumulative, non-cumulative. But despite all this, it is still called only as the preference shares for the purpose of the Companies Act. But again, equity shares can be of normal equity shares or differential voting right shares, what we call as a DVR shares, regulated by Section 48 or 43, power to issue a DVR shares under the Companies Act. But if you see FEMA, for example, the following are considered as an equity. Equity share, like company, when a company issues equity shares, when a company issues a compulsorily convertible preference shares, or when a company issues a compulsorily, not optionally, but compulsorily convertible debentures, these are also treated as an equity, as good as an equity from the perspective of these are compulsory. Anytime these are like potential equity shares. So, for example, when a company issues a compulsorily convertible, normally when you issue shares to a non-resident, you need to file that FCGP and all those compliances and ensure that the valuation is being done on fair value. Allotment is done fair value. Same compliances is required to be done even when you issue a compulsorily convertible preference shares and compulsorily convertible debentures, because these are potentially equity shares. So in your books, you may write it as a debenture, but for the purpose of exchange regulation, it will be treated only as an equity. You need to go and then file the FCGPR form with the RBI when you allot a compulsorily convertible debenture under the FEMA. So the method, the way in which the different regulators view the nature of these instruments are again different. And for the purpose of the income tax law, of course, the unquoted equity shares or the quoted equity shares as such, for which we have, in case if there's an unquoted equity shares, we take into account the valuation mechanism given under Rule 11 UA 1C, sub item B. And in fact, rule 11 UA1, A talks about some jewelry, B talks about immovable property. Rule 11 UA1C, C talks about the shares. In that sub item A, rule 11 UA1C sub item A talks about quoted shares. Sub item B talks about unquoted these shares. As far as the preference shares is the concerned, under the FEMA, when an optionally convertible preference share is a preference share, non-convertible debenture is a debenture. It's not a preference share, but it's as good as in the debt. Even preference share is as good as a debt for the purpose of Ind AS compliances, etc. And even under the income tax law, a preference share is treated as in the preference shares. And for which what we will apply is there is a separate rule item given under sub item C, just like sub item B, rule 11 UA1. Sub item B talks about unquoted shares. Sub item C talks about for any valuation other than unquoted equity shares. So quoted equity shares A, B unquoted equity shares, C says anything other than the above is covered by sub item C. Not a matter of a very great discussion, but just for a purpose of documentation here, I just wanted to present that some of the basis in which these valuation exercises in the broad interest to protect the valuer is also needs to be taken into account. It's just like we take up an assurance engagement, and just like you take up a tax audit engagement, etc., where we really want engagement letter, proper documentation, management representations, etc. As a valuer, it is very important that we do this exercise as under a statutory requirement. So therefore, we should not just like that sign a certificate and then give it. We need to ensure that there must be a proper documentation. So you must comply with the requirement, and very excellent broad guidelines have been given by the Institute of Chartered Accountants. They have introduced something called as the valuation standards. We have also the international valuation standards, and now we have our own Indian valuation standards. Also, we can call it the ICAI. The standards presently they have issued about some 9 standards on the IVS 101 on. Basically, that IVS valuation standards 101, 2, 3 talks about certain basic the approaches. 2, both 3 talks about certain reporting requirements and how do you do a business valuation given by 301. Intangible assets in specific, how do you do, for example, valuation of technical know-how, patents. Broadly, these issues are addressed by 302, and 303 talks about valuation of financial instruments like derivatives, etc. And it very like 201 and 103, for example, and more importantly, IVS 202, reporting and documentations. You need to be an independent valuer. You need to ensure that you collect all the required documents and protect yourself before you give an opinion on the valuations. Getting into the core part now, section 56, which is the main important subject matter of the discussion. I'm pretty sure many of you will be aware. I'm just for the purpose of repetition, I'm just presenting the history of the movement of various clauses and subclauses under 56.2. Where with effect from 1st of October 2009 till 31st of March 2017, we had 56.2.7, which was applicable only for individual and HUF, where it is applicable in case of transfer of given of money, immovable property other than immovable property, where in case it is being given, or for example, immovable property which is given free of cost, or even without any consideration or at a concessional price, you invoke 56.2.7. Of course, it is not applicable in case of relatives. These are also been like there are some exceptions. Then with respect to 56.2.7a, they brought an amendment which is applicable only in respect of firms and companies which are closely held. When there is some shares of the closely held company is being transferred, then they propose to tax the same as a gift under 56.2.7a, and that was in place till 2017. And right now, there are 2 important sections which was applicable and needs to be complied. Is with effect from 1st of April 2013, we have 56.2.7b in respect of companies which are closely held with respect to issue of shares, and 56.2.10 with effect from 1st of April 2017, again, where it is not just applicable only in respect of companies, but it is also applicable for all persons all persons, more particularly when it comes to transfer of shares, the tax in the hands of the shareholders are required to be gauged in and determined in compliance with 56.210, where they have changed the definition of the term person and from applicability. The person means, as you know, individual, HUF, firm, all are covered, and it takes into account money, the nature of assets. It includes money or transfer of money or removal property other than removable property, etc. So while we get into this 56.27b and 56.210, we'll read the Bar Act extract. Probably we will get into the more details. Let's talk about 56.27b first. With respect to the issue of shares, the extract of the section is given here, 56.27b, where a company, not being a company in which the public are substantially interested, receives in any previous year from any person being a resident any consideration for issue of shares that exceeds the face value of such shares. That is, the company is issuing shares at premium that exceeds the face value of shares. Then what amount of premium justification is to be given? The aggregate consideration received for such shares as exceeds the fair market value shall be deemed to be the income of that particular company, right? So for example, where the face value of the share is 10 rupees, the issue price is 50, and the fair, so 56.27b is applicable where the company has issued shares at a price greater than face value. 10 rupees share is been issued at 50 rupees. So what is the amount which is proposed to be taxed here is, if you read the bold lines, line number 3, the aggregate consideration received for such share as exceeds the fair market value. So FMV. So they are proposing to establish an FMV. Let's say the fair value or the fair market value is 30 rupees. Which you are totally collecting a securities premium of 40 rupees, which is 10 rupees share issued at 50 rupees. But the fair value is only 30. So you should have issued only at 30 rupees, but instead you are collecting an exorbitant premium, additionally 20 rupees of premium you are collecting, which is the difference between 50 to 30. So this section primarily at the outset seeks to tax in the hands of the company at 20 rupees extra, taxable under the section, that 20 rupees, 50 rupees fair value, the issue price versus 30 rupees, the fair value, the 20 rupees, which is securities premium in the books of the company, capital profits, that is what is sought to be taxed, and 56.27b in hands of the company. So principle number 1, 56.27b is invoked when a company makes an issue of shares at a price greater than the face value, and then you need to find out whether that the issue price is at fair market value or greater than fair value. See, they have issued at fair market value, no problem, less than that, fine, but they have issued more than that, then the difference between the fair value and the issue price and the fair value, which is the excess premium, which is sought to be taxed here. Point number 1, 56.27b is applicable only when a company makes an issue of shares to a resident. 56. So in case where the shareholders are non-resident, where a company where one foreign investor, for the purpose of giving a growth, is making some investments of 2 crores, then 56.27b is not applicable, because you do the valuation, you take care of the fair value, etc., in compliance with Foreign Exchange, the Management Act, where anyway there is a regulation that when you make an issue to an outsider, you need to do at fair value only. But the fair value there is any internationally accepted the pricing, the methodology, right? And 56.27b is applicable only when a company issues principal 2 shares. It does not use the word security. Presently, it uses the word shares. So, but when you say shares, obviously the question comes: what is 56.27b applicable when I issue a preference share? The answer is yes, because share includes both equity shares and the preference share. So it says the company, not being a company in which the public are substantially interested, receives in any previous year from any person being a resident, right, any consideration for issue of shares that exceeds the face value of shares, and further it also exceeds the fair market value, that except portion what I'm getting. The first proviso says, provided that this clause shall not apply where the consideration for issue of share is received a venture capital undertaking from a venture capital company, and they must be a SEBI registered venture capital company. In fact, SEBI gives a lot of privileges to a venture capital company under the SEBI issue of capital and disclosure regulation. The venture capitalist who makes generally, as you know, you will make an investment in an unlisted company to give a good growth to the company for funding the new ideas, etc. And thereafter, they will go for listing, and then through an offer for sale, the venture capitalists will make a gain, and then will come out gradually after 5 years or the 10 years. So SEBI wanted to encourage the venture capitalist investments, and if you see, in fact, that one of the greatest advantage given by SEBI is any investment made in the capacity of a promoter by a SEBI registered venture capitalist is locked in only for 1 year. Well, generally, a promoter share in a public issue is locked in for 3 years. Meaning, once you go for public from an unlisted company, promoter has to be compulsory be there. That minimum 20%, which is a promoter holding, it has to be compulsory there for minimum 3 years, locked in. Thereafter, only you can sell your stake and then take the exit. But in case where a promoter happens to be a venture capitalist, SEBI says it's locked in only for 1 year, which is in fact a great advantage which is given to a venture capitalist undertaking by SEBI. So on similar lines with the tax laws here also, the exemption is given by a company from a class or class of person as may be notified. So here the government also retains a power that from the applicability of this 5627B, from the perspective of taxing the proposed taxing securities premium, they can, by way of an issue of a notification, they can exempt certain class for the person as well. For the purpose of this class, the fair market value of the share shall be the higher of the two, as may be determined in accordance with such method as may be prescribed, which is given in the Rule 11(u)(a). Prescribed what is mean by fair market value. So generally, you know what is fair value. If you read the definitions given under the Companies Act, accounting standards, etc., fair value is generally a market value, but market value is only a best example of a fair market value. They are saying a fair value is a price which is agreed between a knowledgeable willing buyer and a knowledgeable willing seller in an arm's length transaction. An arm's length transaction, meaning it talks about at least the buyer and seller maintains a relationship at an unshakable difference, so that they are not a related party. So one, it says as may be determined in accordance with such method prescribed under Rule 11(u)(a), and if you wanted to prove a value which is more than that under different method, then you to the satisfaction of the assessing officer, as may be substantiated by the company to the satisfaction of the assessing officer, that in the given case the method prescribed under Rule 11(u)(a), for example, if you feel it cannot be adopted, neither the book value nor the discounted the cash flow you need to revolve around some other method, for example, comparable companies method. For example, the basic idea of doing a TCF, you need a projections, etc. And if you feel like projections and other things are not possible here, so you can work out only on the basis of comparable companies, on the basis of the related size, etc. Then you need to justify the said valuation to the assessing the officer. So at a repetition, some important points which you need to remember under 5627B, which talks about proposing to tax the securities premium on issue of shares. Is this section applicable when the amount is received from a non-resident? The answer is no, as we said that it is applicable only when you collect from a resident. Is this section applicable to issue of preference shares? The answer is yes. As you can clearly find, the word used is issue of shares, and therefore it takes into account both equity shares and preference shares as well. What are the exceptions? We saw two exceptions. One is a venture capital undertaking, and another is such class of persons which can be notified by the central government. Like we will see some notifications down the line. What do you mean by venture capital undertaking? Venture capital undertaking or a venture capital fund. Venture capital company, venture capital fund, and venture capital undertaking shall have the meaning respectively assigned to them in section 1023 of B, which talks about any exemption to income derived from venture capital funds, investments, mutual fund, etc. What are all the, if you look at the second nature of exemptions, where the power is available under 5627B to the central government to issue a notification exercising this power, they have issued the following the notification. That is when a huge hue and cry were going on exorbitant, just because the DCF is permitted, huge amount of the valuation through a discounted cash flow method is being projected and given upon. So there are a lot of assessment issues which are going on where the officers are not able to appreciate the basis or the valuation, because projection is a projection at the end of the day. Next 5 years, I can make some high assumptions, do the projections, and then make a huge amount of valuation. So, but at the same time, these are startup companies, understanding that there must be a flexible ease of doing business, etc. Government has quickly come out with a lot of relaxations with respect to taxing the securities premium for the startup companies, and accordingly the following notifications are being issued. So for an eligible startup, for the purpose of those who are considered to be an eligible startup for the purpose of the Erode ICAI, which covers only certain innovation, etc., you are exempted from the issues that are taxing the capital profits of 5627B. And also we have those entities who are startup companies presently, which are registered under the DP, the Department of Promotion of the Trade and Commerce, DPIT. You have to submit Form 2, and then as per this, if you go through this notification number 127E, and also in supersession of the earlier notification they have issued, and the consolidated notification and the corresponding guidelines with respect to claiming an exemption for us eligible startup company is also given in the Department of Promotion of Trade and Commerce also, where these guidelines have been available. So presently the concept is simple. If you are a startup company and as per the criteria which is available, you submit form number 2, they give you a basic recognition that you are exempted from the 5627B issues. And if you are one step forward, you are also the startup, what you call an eligible startup, because not all startups are eligible for exemption under Erode ICAI. Their profits are sought to be exempted for certain prescribed years. There, the startup means only those companies which are into scientific research, innovation, etc. And those companies are again exempted from the taxing issues under this particular. The prescribed methods for determination of the fair market value for the purpose of the 5627B, as per the Rule 11 UA2, the fair market value can be determined the option of the SC as follows: net asset value method, where you go with the formula given under Rule 11 UA2, right, sub item A, or discounted cash flow method, which is given under Rule 11 UA2, sub item B. Now, the important point is, as on what date you need to do this valuation for the purpose of the issue of shares by the company. Valuation date should be on the basis of the financials drawn on the valuation date. If the financials as on valuation date are not drawn up, the last drawn financials may be referred. This point is very important because unlike 5627B, in fact, this is one of the very challenges presently being faced with respect to the valuation. Unlike 5627B, which is very clearly given that the valuation date can be the latest financials available, or if not, you can even go for the latest drawn financials. So let's say, for example, I'm yet to finalize the financials of 31/3/20, then I can go on 31/3/19. If there is no very significant events as a valuer, you find that during 1 year have taken place. Now, if you have, but if you go through 56/210, where they are saying the valuation has to be done on the date of the transaction. 56/210 is applicable for transfer of shares, unlike 56/270, which is applicable for issue of shares. So for 56/210 transfer, for example, suddenly a shareholder is selling the shares on, let's say, on 3rd of October 2020. Then technically, if you read the law, it says you need to do the valuation on 3rd of the October. So the question is, you need to prepare a financials as on 3rd of the October, and then with assets, because they have given the formula, which is the assets on the date, less liabilities on the date, etc. So you need to do evaluation on that particular day, and which will be a very great challenge again. But generally, what today, I mean, it's sort of an absurd rule, which may not be possible, because that too, shareholder may transfer the shares at any point of time at his own will. But then on that day, if you want the company to prepare the financials for the purpose of knowing the value, etc., then it becomes a trouble activity again, because we cannot expect the shareholder to transfer exactly only at 31st March or 1st of April, etc. Like presently, some cases, what we do is we may but do a valuation on the latest available and get a management representation thing that there are no significant material events which have taken place from the valuation date given and then the date of transaction. But again, these are at a great risk because unless the department comes out with the clarification and sort of circular or change the rule and amend the rule, because amending the rule is very simple. You amend the rule by saying that a similar position what you find in yellow shaded thing, which is a latest drawn financials, which is possible for 5627B for issue of shares, should also be permitted for 56-10, also with respect to transfer of the shares, which is not there. There we will see there when we go to 56-10. Now, for the purpose of issue of shares now, shares are, whenever a company issues shares, going with the rule under the tax law, you issue shares at fair value, fair market value. So what is a fair market value? Okay, chalo, determine first under net asset value. If not, I will probably teach you that. Okay. Don't go beyond that. Otherwise, I'm going to tax it, is what the principle. If you are under a cushion of exemption, this, that, etc., fine. Otherwise, you have to go by this particular. Now again, the exemption is only available for the startup companies, etc. For a very long time, you cannot remain a startup company, and also the size, etc. also matters. So therefore, it assumes importance with respect to going by this of basics to B. The fair market value on the basis of net asset value method, which is given under Rule 11 to A. The fair market value of the unquoted equity shares will be basically assets minus liability proportionate to your number of shares. The PV and PE is nothing but paid up value of equity shares, and total amount of paid up equity share capital as shown in the balance sheet is PE. PV and PE, let's understand as, for example, A minus L is, as in generally we understand it's some sort of a proposing to establish a net worth. It's nothing but capital plus reserves. So we compute the net worth on the basis of either the asset route or the liability side route, which say it comes to 1 crore. And out of the total, let's say 1 crore shares, they propose to transfer 30 lakh shares. So how do you compute the proportionate value is net worth A minus L multiplied by 30 lakhs divided by 100 lakhs. So that PV is what you paid up value of intending to transfer the issue, and then what is PE is total paid up value of such equity shares, total paid up of equity shares shown in the balance sheet is concerned, which is proposed to be issued versus. Now, what is A? Book value of the assets in the balance sheet as reduced by an amount of tax paid as deduction or collection at source, or as advance tax payment is reduced by the amount of tax claimed as refund under the Income Tax Act. Any amount shown in the balance sheet as asset, including the unamortized amount of deferred expenditure, which does not present the value of any asset. So all book value of assets, they are permitted to consider in your asset side. But you should not consider, the following things are not considered as asset. Book value of the assets in the balance sheet, that's the first point, as reduced by. So you should not consider, so you can say, you go with the total value of an asset, take total value of the asset in the balance sheet as reduced by. You should not consider the following as an asset: tax paid, if it is a debit balance of tax assets, etc., collection, etc., or as advance tax, or receivable, refund, etc., under the Income Tax Act, and any amount shown in the balance sheet as asset, including the deferred. These are notional, fictitious items like deferred expenditure, etc., which will generally, nowadays there is no concept of any deferred expenditure. Generally we will show we will debit it to the P&L. If at all we have shown some deferred expenditure on the asset side of the balance sheet, that should be notional, fictitious. That should also not be considered as an asset for the purpose of the determination. There are many issues which are revolving around here. When you say issues revolving around the valuation as such. For example, they are talking about you should not consider the amount of tax paid as deduction or collection at source, which is your TDS receivable or advance tax, which is normally a tax asset available in the balance sheet. Because they have not addressed about what is called MAT tax credit. For example, many companies which pay the tax under the 115 JB, where it's like an advance tax where they can pay tax now and then they can treat that as a tax credit and use that credit against the future tax liability when they pay the tax again under total income. So whether the MAT tax credit can be considered as an asset or it should be excluded, because they are generally saying exclude as reduced by is exclude the tax paid, any tax paid as deduction or collection source, etc. So that's one important question. But in my view, the MAT paid should be considered as the asset because there's no specific exclusion on that. And similarly, what happens to deferred tax assets if in case that is there on the DTA side, whether that should be considered or not? Because you find the word amortized, unamortized. You should not consider unamortized amount of deferred expenditure on the fourth line. You can read, which does not represent the value of any asset. So technically, like these DTA etc., which are made for the purpose of book adjustments and determination of the true net profit etc., should be considered as does not represent the value of any asset as such, and therefore these DTA assets should not be considered is what you might do as. Similarly, there are some challenges on what can be considered as an asset and what cannot be considered as an asset. So prima facie, when there is a benefit of doubt, because it says all book value, all assets is the book value. Then you also have the book value of what needs to be detected is L, A minus L. L is the book value of liabilities. Obviously, your total side of your balance sheet is liability, or liability side of the balance sheet. Consider that minus your capital, reserves, etc. needs to be, so that you will get what we call left out amount of the actual external the liability like loans and debt component, including short-term provisions, etc. So excluding paid up equity, share capital, amount set apart for undeclared dividends, reserves and surplus, provision for tax, provision for unascertained liabilities and contingent the liabilities. Obviously, you will not make a provision for any contingent liability, but wherever there are cases where there's a contingent liability, we'll generally look, but wherever there is certainty of happening of an event in compliance, like for example, AS29, you may create a provision in some cases, like for example, a provision for warranty, but it is an ascertained liability. We will not say an unascertained. So if it is an unascertained liability, we have to exclude in the liability computation. Like for example, a gratuity liability, employee benefit expenses provision. These are ascertained liability. And there are various court judgments also which accept the fact that provision for warranty claims made in the books of accounts is an allowable expenditure, etc. And provided it is being made on certain reasonable scientific basis on the basis of the past experience. So at the liability and the provision ascertained liability. So unascertained liability are the other. So you need to exclude that. So total liability side, capital reserves, external liability. We need to ensure that provisions are on the unnecessary. You have to remove that. So in that A minus L, proportionate with respect to the valuation, what you're going to issue, what you determine the valuation. So this is one method with respect to the valuation. So going back again here. So what is the prescribed method? Net asset value, Rule 11 UA to A, or the discounted cash flow, Rule 11 UA to B. Now, coming to the discounted cash flow method with respect to the valuation, to give a broad summary where discounted cash flow as a valuer, when you propose to establish a fair value under the DCF method. This method presently for the purpose of income tax law, only a merchant banker can give the report. And if you are a startup company, you need not have to go. Only compliances will come probably under the Companies Act, where a registered valuer is sufficient if he issues. But for the purpose of Companies Act, you need only a merchant banker the valuation is. So under the discounted cash flow method, as you know, where the valuation is on the basis of the futuristic model. So you prepare basically in order to know what is a fair value of the share. My company is a 10-year-old company. My company is come out with a lot of track records. Today, the value of assets, all these are reflecting in the value. But when a new investor would like to onboard a new investor, I would like to issue the shares of my today's 10 rupee shares at 100 rupees or 200 rupees or 500, taking into account the efforts as a promoter I have put in over these many years, etc., which the new investor are going to enjoy at time zero itself when he joins, as a result of my efforts which I have put over the last year, etc. In some other angle, we may call it as a goodwill, etc. These all needs to be factored in while doing the computing the premium which a new investor needs to pay. So one scientific method of the accepted method of valuation is what we call the discounted cash flow method, where also called as an income-based approach with respect to the valuation. So we have broadly two methods of income-based approach. An asset-based approach is nothing but taking into account all your asset minus liability divided by the number of equity shares will give you what is the value per share. So the income-based approach is the discounted cash flow, or also we have the capitalized earnings method. Like in the லாபத்தை earn பண்றதுக்கு 10% இன்ட்ரெஸ்ட்னா அதுக்கு அப்படியே கேபிட்டலைஸ் பண்ணி அது என்ன வேல்யூ அப்படின்னு கண்டுபிடிக்கும். ஸோ அது வந்து கேபிட்டலைஸ்டு earnings method. So and we use cash flow because the question comes as to whether profit should be taken as a base or cash flow should be taken as a metric for the purpose of measurement of performance. As you know that cash is a superior metric of business performance. Therefore, even some cases we say there is a net loss, but it is because of depreciation and impact. Where we say there is a cash surplus, we find that there is a we are happy to note out the positive side from financial management angle. So of the two, DCF is most preferred the method, that is between the capitalization and discounted cash flow method. So under the DCF method, you forecast the business performance for a reasonable period, at least for one business cycle. Business cycle na 5 வருஷம் is one business cycle. So 5 வருஷத்துக்கு you forecast minimum, and some cases it can go even beyond that also based on the contract period or agreement period, etc. And using the concept of time value of money, you discount all those future cash earnings into present value. Whatever the cash flows you are going to accrue to the business in year 5, you will bring it at time 0. Year 4, you bring it at time 0. So all these future cash earnings will be brought at time 0, and what we call it as estimation of free cash flows. So you can do the valuation under this method under two approaches by determining what is called as free cash flow. So there are two types of free cash flows. One is called as free cash flows to the firm, which is called FCF. Another thing is called as free cash flows to equity. I'm not going to very high intricacies. Some of you may know that, and even those who are not maybe done into or get into this valuation, etc. The idea is not to go in deep with respect to DCF. I just wanted to present a broad picture. At least you know what is what. So there are free cash flows to the firm, and there's something called free cash flows to the equity. So simple free cash flows to the firm before interest. Before interest. So I wanted to know from this project what is the total cash flow I get, irrespective of the funding pattern. Now on the fund I may fund it by way of loan or an equity. That's another decision. So but evlo reward varudhu, what we call project IRR. So அது எவ்வளவு reward வருது, இன்ட்ரெஸ்ட் எல்லாம் டிடக்ட் பண்ணாம, லோன் காம்பனன்ட்லாம் நான் கன்சிடர் பண்ணாம, எவ்வளவு ஃபியூச்சர் கேஷ் ஃப்ளோஸ்ல ரெவென்யூ இந்த எக்ஸ்பெண்டிச்சர் எல்லாம் கழிச்ச அப்புறம் இவ்வளவு லாபம் வருது அப்படின்றது. that method probably can call free cash flows to the firm as an enterprise as a whole without resorting to a particular funding pattern. Free cash flows to the equity is equity specific holder perspective. You do a business valuation. After detecting all the interest and other components, you determine this. So these are all the two broad methods which are available for the purpose of determination of the future cash flows. So time forecasting of cash flows, bringing down the cash flows is using the time value of money, TVM, using the appropriate discount rate, and divided by the number of equity shares will give you what is the value per share. So that value will take into account the future performance of the company. That will take into account the cost which is required to be paid for the goodwill and other aspects. I share this PowerPoint. This is basically a formula for determining the free cash flows for the purpose of the sample cases. How do you determine it? I will share this PowerPoint for you. Getting into the discussion part of the issues. So who is authorized to issue the valuation report under the DCF method for the purpose of 5627D? So as per rule 11 UA 2B of the tax rules, read with the notification, only the merchant bankers with effect from 24th May 2018, only merchant bankers are now authorized to issue valuation reports. Book value accounting, chart accountant can also do. Rent option DCF on the only merchant banker can issue. Huge representations being given by, I believe, IC also on this particular issue, but maybe the organization, as I said, will happen in the draft values will taking place. Now, whether the assessing officer can disregard the method adopted by the assessee and carry out the valuation of shares using a different method. So So I have proved, for example, exorbitant amount of premium I book la collect பண்ணி வச்சிருக்கேன். Discounted cash flow பண்ணி 10 ரூபாய் ஷேரை வந்து 600 ரூபாய் அப்படினு சொல்லி fair value determine பண்ணி projection போட்டு merchant banker certificate பண்ணி கொடுத்திருக்கேன். But the AO says இல்ல fair value 600 ரூபாய் இல்ல, fair value 300 ரூபாய். Now I want to go with a particular method. So then he wanted to prove that method, and he wanted to tax the remaining the excess 600 and 300. He wants to say that it's an exorbitant amount of premium. He wants to tax that. Can he do so? So if we can on the various settled the outcome of cases. In the case of Innovative Payment Solutions Private Limited case, I've also when I circulate this PowerPoint, I will also circulate along with the detailed judgment case laws of these, so you may use it for reference as well. So the Bangalore Tribunal addressed the issue on the application of DCF methodology and the powers of the AO to inquire into it. In the said case, the assessee could not conclusively establish that the projections used for discounted cash flow valuations were prepared scientifically. The tribunal referred to the technical guide on share valuation by research committee of the ICAI. Now we have the valuation standard as a guideline, where it was stated that the DCF value is good as the assumption used in developing the projection. So DCF method, one of the fundamental important aspects on the projections. Next to 5 years to prepare for the projections based on the fair value of the share company. So the projections evolo reasonable, that is based on presumption, is based on assumption. So other assumptions la evaluate panalama AO appadina AO can adopt evaluate the assumptions, etc. They're saying these projections should consider various factors of industry. The tribunal held that if the assessee has opted for the DCF method, AO cannot disregard it and adopt another method. However, the AO is well within his rights to examine the methodology adopted by the assessee and the underlying assumptions. If he is not satisfied with the assumptions, he can challenge the same revenue growth expenditure trend போகுது. So அது மாதிரியான ஒரு assumptions வந்து ரொம்ப exorbitant இருக்கு. On the basis of the nature and size, we find that the projections is not reasonable, etc. On those grounds, whether the tribunal can challenge the valuation to be exorbitant, that much amount of exorbitant value irukka vaayippu illa, it has to be less na, yes pannalam appdi sollu. There's no. Similarly, decision of the Delhi tribunal in the case of agro portfolio provided method, contrary judgment, it was held that since there was no possibility of verifying the correctness of the data supplied with the SSE to even to the merchant banker, the correctness of the result of the DCF could not be verified. And so AO had no option but to reject the DCF method and to go by the NAV method to determine the. This is against the spirit of the law itself. See, valuation as such is an art or specific situations. Projections, it would be general. You cannot question it very exorbitantly. 10% growth very reasonable in the publication, but exorbitant assumption that in fact there are many cases even not under the tax law, but even under the Companies Act, when there are engagements with respect to the valuations. In fact, the classic example of evaluation case study, if you take from a court judgment, is Cadbury India case study of the Supreme Court. So in fact, there was a valuation required for the purpose of exiting a minority shareholders on the perspective. So what happened there is the valuation was done by one of the big four auditing firm. The Supreme Court have gone into the valuation report step by step. They have questioned in the discount rate, in the projections, left, right, center. They have questioned, and then they have previously done the valuation under the comparable company method. Then they asked a question: why cannot you do the valuation under the DCF method? And then also, while they submitted the valuation of the DCF method, they've also questioned the basis of the factors for the valuations. Like you find, for example, the extract of the Cadbury India case study is being given here. So various methods. This is in the context of the company law, though. So market price method use panlama in the case Cadbury India case. So then they finally price of recent transactions, comparable companies method. So then they finally they have boiled down to two methods, while they said all these other methods cannot be used. So comparable companies method cannot be used, but comparable companies method rather, and DCF method is what the finalized method for Cadbury India, the court finalized differently. So we have instances where the court, wherever there are unreasonable parameters being used for valuations, the courts have gone into valuation. But generally, the general settled court judgment is Once a firm of a reputed chartered accountant does the valuations, most probably, most cases with a reasonable assumption, etc., has been made, the court, the tribunal will not let you go beyond it unless you prove that there is some fraud or some detrimental with respect to the valuation, the interest. Now, coming back to the question on what are all the rules for valuation of preference shares, as we discussed in the initial the snapshot, Rule 11 UTE, which is specifically applicable for valuation of shares for the purpose of 5627B, covers only unquoted equity shares within its ambit, and there is no reference to the preference shares because it specifically says Rule 11 UA2, not unquoted share but unquoted equity shares. So then, as I said, we need to go to sub-item C, which prescribes the valuation for any other shares other than unquoted the equity shares, where they are saying the following: the fair market value of unquoted shares and securities other than equity share in a company which is not listed in any recognized stock exchange shall be estimated to be price it would fetch if sold in the open market on the valuation date. Very important, on the valuation date. And the assessee may obtain a report from merchant banker or an accountant in respect of such valuation. So, for the purpose of 11 UA2 sub-item B, for the DCF for unquoted equity shares, you need only a merchant banker. But if you come to, for the purpose of, for example, preference shares, etc., 11 UA1 CC will apply, where the section says, the rule says you can either be a merchant banker or an accountant. So your chartered accountant can also do an evaluation. And it is also very important that there are some court judgments which are specific, just like as I said, a convertible, compulsorily convertible preference shares for the purpose of RBI is as good as an equity share because it's a potential equity shares. There are some, whether to go with Rule 11 UA, the rules with respect to the unquoted shares, or see for any other shares you can come and then make settlement. That also depends upon the substance, on the nature of the instruments. For example, it has been held very well in 2M Power Health Management Services Private Limited. The associate has allotted convertible preference shares at a premium, and the holder of these preference shares had the right to attend the general meetings, vote on resolutions directly affecting their interest. The tribunal held that with regard to the facts of the case, the nature of the issued share is actually that of an equity because it had the character of compulsory convertible, etc., not a preference shares. And then they said you need to do the valuation as an equity and not as a preference shares in 2M Power Health Management Services Private Limited. So from the above judgment, one can infer that it is very important to identify the basic nature of the securities being issued and the rights attached to it to determine the valuation methodology under Rule 11 UA. Now, coming to the second part with respect to the valuation on with respect to the transfer of shares, where you bring 56 to 10 or 50 CA. Now, before that, probably we will take up some questions now under the first part to make it a little more so Jairam Natarajan sir asked a question. Maybe initially I think I missed out that. 5627B apply if company issues convertible debentures, which is applicable for shares, and debentures are not shares, as we think your question was just answered as per that previous judgment, sir. You may there is a reference to that, though I agree specifically there is a reference only to, we need to check that as well. Similarly for convertible notes, also meaning going by the spirit of this particular the judgment, which says it's very important to identify the basic nature of the securities being issued, rights attached to it to determine the valuation methodology under Rule 11A. Any other questions from the learned members? You can post it before we go to part 2, 56 to 10. Maybe I will continue. In the meantime, you can type the questions in chat as and when we go. I can see the chat option. Sorry, I forgot to see the chat during the last 1 hour. I can do as and when it strikes your mind, you can post the questions kindly in the chat. I will activate that and I will go through that now. The Finance Act 2017 had brought into force two major amendments. Insertion of clause 10 in 56.2 had replaced clause 7 and 7A of 56.2. This section provides that receipt of money or specified property by any person for inadequate consideration or without consideration from any person shall be subject to tax. And also, parallelly, they have they brought in 50CA, just like 50C is available for transfer of movable properties to ensure that the capital gain taxation is made at fair value. To provide that where consideration for transfer of shares of a company other than quoted share is less than fair market value of such share. So for quoted shares, you go by the listing, whatever the price. For other than quoted shares, so this is applicable even for technically unquoted shares and debentures, etc. Less than fair market value of such a share. The FMV determined as per rules shall be deemed to be the full value of the consideration for computing income under the head the capital gains. So in case of a closely held company, where there are basically some loopholes which have been previously available, I will share some illustrations. Those loopholes which have been existing has been plugged now by introducing the 50CA, by establishing that the transfer of shares is being made at the fair value only. So in case it is made less than fair value, then for the purpose of assessing the capital gains, the fair value of such asset should be deemed as a consideration received, and then you need to tax the capital gain, assess the capital gain on the basis of that particular fair value only. The background of 50CA, prior to the introduction of the section, where shares were sold by the SSC for a consideration which is not in conformity with the fair market value of the shares, there was no mechanism available under the Act to substitute the full value of consideration as disclosed by the SSC by any other value for the purpose of computation of the capital gains. Because 50C, what we have earlier, was available only for immovable property, land or buildings or both. So which is not applicable in case of shares. And to plug this loophole only, 50CA was now introduced. Correspondingly, 56 to 10 was also made applicable, was also introduced. So the extract of the bare section of 50CA before we go to some illustrations is as follows: where the consideration received or accruing as a result of transfer by an assessee of a capital asset, being a share of a company other than a quoted share, is less than the fair market value of such share, determined in such manner as may be prescribed. The value so determined shall, for the purpose of section 48, the capital gains, be deemed to be the full value of consideration received or accruing as a result of such transfer. So very similar to the immovable property. So in case where the transfer of shares, 10 rupees shares, the fair value, the formula is given here. We need to see the formula. Just like for 56 to 7B, we saw two methods of value. Formula has been given. One is the net book value, for which formula is there, A minus L, and proportionate multiplication of the number of shares to be issued. Similarly, for here, there is a slightly different formula than book value only. Slightly modified, we can say there's a modified book value. The book value, what the formula given for 56 to 10 read with 50CA, because both for the purpose of 50CA and 56 to 10, the value is only as per rule 11 U. So therefore, the formula for the purpose of this vis-a-vis 56 to 10 is slightly different, right? So if a 10 rupee shares whose fair market value is 100 rupees being sold for just a 60 rupees, and for the purpose of the capital gain, you have to take the consideration as 100 fair market value and then compute the tax, is what is being primarily given by this 4 lines. The provision of this section shall not apply to any consideration received or accruing as a result of transfer by such class of person and subject to such condition as may be prescribed. Purpose of this section: quoted share mean the share quoted on any recognized stock exchange with regulatory from time to time, but the quotation of such share is based on current transaction made in the ordinary course of business. Listed shares and which basically an important governing provisions. It is applicable to all assets. Unlike 56 to 7B, it is applicable only when a company issues shares to a resident. So 50CA, if you see, applicable to all SSC, resident, non-resident, related, unrelated, all those. applies to all shares, whether equity or preference. Unquoted shares in some cases should be primarily a capitalist, of course, not applicable with respect to gains from transfer of an interest in a partnership, trust, where the property of such entities consists directly or indirectly of an immovable property. Some cases, because of the definition, wide definition of this unquoted shares, as per the explanation, in some cases you will find even a quoted share will also come under the definition of the unquoted for the tax law. Where unquoted equity shares are contributed by a partner to a firm, question arises whether the provisions of section 50 CA would override again 45(3) of the Act. No tolerance band has been provided. Thus, fair market value, as per the new formula method, will be taken as full value of consideration, even if difference in FME and the sale of consideration is marginal. In case of sale consideration being less than fair market value, the seller will be taxed under 50 CA on the ground that he has not declared true consideration. On the other hand, the buyer will be taxed under 56(2)(10) on the ground that he has understated the purchase consideration. So, which is deemed as a gift, meaning if it is reverse, and meaning you need to transfer the shares at a fair value. The idea is simple. If you have 10 rupee shares, if the fair value is 100, and you have issued at a lower value, which means from a buyer's perspective, 100 rupees worth of shares and getting it for 60 rupees. That 40 rupees is technically deemed as a gift. 100 rupees fair value worth of share is issuing it for 60, which means that 40 rupees is indirectly deemed as a gift. So for the purpose of seller, you are going to tax, you'll make him pay capital gain tax by taking consideration at the fair value, and for the purpose of the buyer, 56(2)(10) again, any person, he will be paying tax in case where he does. So you need to therefore make a transfer of shares only at the value given as per this particular thing in order to escape the notional taxation. For example, X transfers his unquoted shares purchased at a cost of 8 lakhs to Y at 10 lakhs, whereas the fair market value of the shares as determined in the prescribed manner is 50 lakhs. Fair market value taking into account certain assets which are in the possession of the company, etc. Let's say because of that the value is high. Thus, in this situation, the provisions of section 50 CA would be attracted in the hands of the seller. So, 50 lakhs worth of shares, he sells it only for 10 lakhs. So, in the hands of therefore the seller, whose full value of consideration for computation of the capital gain would be taken as 50 lakhs and not 10 lakhs. So, Y, who is a purchaser, again, would be liable to tax under section 56(2)(10)(c) on 40 lakhs deemed as a gift, as income from other sources, because he has indirectly got a benefit. 50 lakhs worth of shares, he bought it for only 10 lakhs. That's right. So it's both side applicability. The seller side 50 CA, the buyer side 56(2)(10)(c). Hence, a difference of 40 lakhs between the fair market value and the actual consideration will be taxable. So to repeat and summarize, under section 50 CA, in the hands of the seller, you tax it at 50 lakhs by computing the capital gains for the purpose of the capital gains. And under section 56(2)(10), in the hands of the recipient for the purpose of income from the other sources. Where does this entire boomerang actually comes, and why there's such issue on consideration, and also a recent amendment with respect to the formula? So previously they had only one formula which we saw earlier for the purpose of issue of shares, the book value, but now they have slightly modified the formula and given separate computation rules for book value for the purpose of 56(2)(10), where, for example, consider this following case very broadly. I put it in a very simple manner to basically understand. Let's consider a balance sheet of a company ABC Private Limited, which is, let's say, incorporated in the year 2010. So, ஒரு immovable property, ஒரு land 1 கோடி ரூபாய்க்கு வாங்கியிருக்காங்க. ஸோ அந்த பேலன்ஸ் ஷீட்ல அது அசெட்டா இருக்கு, 2010 வாங்கியிருக்காங்க. ஸோ அந்த கம்பெனியில குமார் அண்ட் மிஸ்ஸஸ் குமார் ஒரு 50 லட்சம் ரூபா 50 லட்சம் ரெண்டு பேரும் போட்டு அந்த லேண்டை வாங்கிட்டோம். ஸோ ஒரு லேண்டை வந்து பர்சனல் பேர்ல வாங்காம ஒரு கம்பெனி பேர்ல வாங்கியிருக்காங்க. So நாளைக்கு, let's say 2019, 2020 or today, after 10 years, they wanted to sell the land, immovable property. So அந்த கம்பெனில பிரதானமா பார்த்தோம்னா immovable property ஓட அசெட் தான் நிறைய இருக்கு. So நாளைக்கு ஒரு பிளானிங் ஆங்கிள் வந்து இந்த இமூவல் ப்ராப்பர்ட்டி இண்டிவிஜுவல் டு இண்டிவிஜுவல் ட்ரான்ஸ்ஃபர் பண்ணா கேபிட்டல் டாக்ஸ் அண்ட் ஆல்சோ யூ ஆல்சோ ஹேவ் வாட் யூ கால் தி ஸ்டாம்ப் டியூட்டி அதெல்லாம் இருக்கு. இங்கன்னா ஒரு சிம்பிளா ஷேர் ட்ரான்ஸ்ஃபர். ஸோ நாளைக்கு குமார் வந்து இந்த லேண்டை விற்கணும்னு நினைக்கிறார். ஸோ தேர் பை வாட் யூ வில் சிம்பிளி டூ ஜஸ்ட் ஃபில்ஸ் எஸ்ஹெச் ஷேர் ட்ரான்ஸ்ஃபர் ஃபார்ம் ஃபில் பண்ணி ராம்கிட்ட வித்துறாரு. எவ்வளோக்கு? அதே 1 கோடி ரூபாய்க்கு ஷேர் ட்ரான்ஸ்ஃபர் போட்டு வித்துறாரு. So the balance sheet as at 31st March 2019, if you see immovable property, land of in the Rams and the immovable property, the land again continues 1 crore. எல்லாமே சேம். ஷேர் ட்ரான்ஸ்ஃபர் மட்டும் நடந்துச்சு, ஸ்டாம்ப் டியூட்டி கிடையாது, ஷேர் ட்ரான்ஸ்ஃபர் பண்ணி எல்லாம் பண்ணியாச்சு. So maybe the other part of the larger consideration could be routed through a different model also. No, 1 crore worth of land, but today actually the market value of that land could be 10 lakhs, 10 times of that, for example, 10 crores. So technically speaking, let's say this 1 crore share consists of 10 lakh shares of 10 each. So this 10 rupee shares, just like this land value have gone up by 10 times, these value of share 10 rupees should also be 10 times. So when the share transfer takes from Kumar to Ram, it's very clear that they should have agreed on a fair market value of 100 rupees. They would have not just transferred the shares at 10 rupees. So that's where they wanted to give a formula and say that while you are valuing an asset now, they are saying A minus L. While A is considered generally all book value, but if it is an immovable property is there in that, they are saying value that immovable property at a fair market. So while if you do a book value computation for the purpose of this valuation, you do what is called the book value of the assets, taking into account that restating the value of the land at 10 crores, for example, 10 times, and then determine the fair market value as 100 rupees per share. So accordingly, even if Kumar to Ram, the share transfer had taken place at 10 rupees, but for the purpose of computation of the capital gain is considered, we will substitute the price at 100 rupees. That's what the focus is about. This is one broad loophole which was available, which was now plugged by giving a restated formula. Once I show the formula, probably you will be able to connect with this example and then appreciate the fact. Triggering the judgment of the Karnataka High Court in Boruga Engineering, in this case, the revenue contended that the transaction of sale of share was a colorable device and virtually immovable property had been transferred. While rejecting such arguments, the High Court observed as follows. The assessee, by resorting to such a tax planning, has taken advantage of the benefit of the law or the loopholes in the law, which has ensured his benefit. So this is prior. So after seeing how this loophole has been exploited within 4 corners, it is the Parliament, they directed, the Karnataka High Court directed, it is the Parliament which has to plug the loophole by modifying the law, and that's the reason where we have the revised formula now. Similarly, in Maya Appliances, the Chennai Tribunal held that in this case, according to revenue, the assessee sold the actual land and building in the guise of sale of shares, and thus the provision of the TCs are public. However, the tribunal declined to adopt the argument and held that no question of invoking the provision of 50C, which is only for immovable property. So, though by substance in the transaction balance sheet, immovable property தான் மூவ் ஆயிருக்கு. ஸோ அதனால இது வந்து 50C அப்ளை பண்ணலாமா அப்படின்ற கேஸ் நான் வரைச்சு இல்லை எல்லாம் பண்ண முடியாதுன்னு சொன்னா that's the reason they brought it now. The ஷேர் ட்ரான்ஸ்ஃபர் மூலமாக ஒரு immovable property transfer. So keeping this in view, now if you see this formula, the fair market value of an unquoted equity shares are required to be given. So on the previous formula, simpler. They are saying A plus B plus C plus D minus L. So A minus L in 56 to 7 BK. So for the purpose of transfer of shares 50CA and 56 to 10, A plus B plus C plus D minus L. So in the now same the asset. A plus B plus C plus D same the asset. So this is given under Rule 11UA1C, subitem B, after the amendments. For the purpose of 50CA or 56 to 10, the fair market value of an unquoted equity share shall be as per Rule 11UA1C, subitem B. So what is A? Book value of all assets except those mentioned at B, C, and D below. So balance sheet எல்லா other assets book value எடுத்துக்கோங்க, computer, furniture, as reduced by similar anga paatha mari the refund and unamortized expenditure and the concept same. B, so supposing balance sheet la jewelry or artistic work alla irundhuna adoda fair value as per the valuation report of a registered valuer consider pannom. Similarly assets la வந்து வேற ஏதாவது shares இருந்தது அப்படினா fair market value of அதாவது we saw this balance sheet of XYZ private limited. So this XYZ private limited in turn, yeah, take an example of this particular so as on 2010 ABC private limited. So you find instead of a land and building, let's say there is an investment in XYZ private limited. The assets which are released investment in XYZ private limited. So this transfer of shares again takes from Kumar to Ram, share transfer, but assets it investment in XYZ private limited. But if you see the balance sheet of XYZ private limited company, again they are having the land. So indirectly again I'm transferring the land only by transferring the share of the company, but shares in my company is only securities, land. When they modified the rule to say that immovable property should be valued at fair value for the purpose of determining the book value, there was a loophole. So they have now plugged the loophole by saying that if in your company's balance sheet, if you are having some investments in another company, that should also be fair value. That should also be fair value to determine the real fair value. So fair market value of shares of securities as determined according to this rule again, you need to apply, determine that. Stamp duty valuation respect of any immovable property. Stamp duty valuation. So balance sheet 1 crore removable property irundhaduna adu book value munadi eduthum. Ipo vandu real in today's stamp duty valuation 10 crores na 10 crores eduthu you have to determine the net asset value. Ella asset divided by minus liability divided by the number of shares. So liability பொறுத்த வரைக்கும் similar explanation what we already saw for 56 to 70. So the real base என்னன்னு பார்த்தோம்னா 56 to 10 ல so balance sheet ல immovable property இருந்ததுன்னா அந்த book value கண்டுபிடிக்கிறதுக்கு அந்த immovable property fair value பண்ணணும். அதே மாதிரி shares securities இருந்ததுன்னா அதையும் you need to do what is called as the fair value of that. Proportionate to what is being transferred and then what is being that's PV and the EP basically. Yeah. Having that, have made an effort to really plug the loophole, sort of a loophole which has been existing, but some of the challenges in actual implementation or following is, as we discussed while we are discussing 56 to 7B, the one important challenge between 56 to 7B and 56 to 10 for and also 50CA is the valuation rate. In case of 56 to 10, FME is to be determined basis audited financials, so audited financials. As on the date of transaction, closing the financials and audit thereof alongside the transaction closing date is practically an impossible task. Suddenly 3rd October on the 3rd October la audited financials கண்டுபிடிக்கிறது. அதுவும் என் கம்பெனி இன்னொரு கம்பெனில ஷேர் வச்சிருந்தா அந்த கம்பெனிக்கும் நான் வந்து ஃபேர் வேல்யூ கண்டுபிடிக்கும் போது அவனோட புக்ஸும் க்ளோஸ் பண்ணணும், அதையும் ஆடிட் பண்ணி வாங்கணும். இதெல்லாம் ப்ராக்டிகலி நாட் பாசிபிள். தட்ஸ் வேர் ஐ சேட் லேட்டஸ்ட் ப்ராக்டிகல் எடுத்துட்டு ஒரு மேனேஜ்மெண்ட் ரெப்ரசன்டேஷன் வாங்கியது இப்போதைக்கு one way to close the issue. Again, the spirit of the law is straight up அப்படி இல்லை. How can a shareholder insist a company to get his accounts audited in the middle of the year when he is share transfer to his personal thing, right? While for determining FME in case of 56 to 7B, it is categorically mentioned that if the financial as on valuation date are not drawn up, the last drawn financials may be referred. There is no such similar relaxation available for this particular provision. So to overcome the hardship, the CBDT should look into this particular issue. Again, valuing investments held by an entity, another entity. The mechanism for determining the fair market value for 56 to 10 provides for valuing even the investments held by the entity as per Rule 11UA. This requires even the financials of those entities to be drawn and audited. This becomes a real challenge again. That's number 2. Cross holdings. The issue becomes even grave in case of cross holdings on circular chain holding scenario. This rule is completely silent on the method to be scenarios. As such, adopting any particular approach may not be again free from the litigations. Investment in foreign subsidiaries. The rule states that fair market value of shares or securities as determined according to this rule should be considered. Hence, for any investment in subsidiaries, The value of such investment shall be computed by doing the same fair market value exercise under the Rule 11 by using the balance sheet of the subsidiary. So, என்னுடைய balance sheetல investment in subsidiary ஒரு asset இருக்கு. அந்த investment costல இருக்கும். Long term அந்த costல disclose பண்ணுவேன். Case 13 படி. So, but ஆனா அது fair market value நான் கண்டுபிடிக்கணும் for the purpose of doing what is called the real fair. So, அது subsidiary ஓட books of valuation பண்ணி எடுத்துட்டு then I have to determine the how the valuation of such shares to be done, such investment of foreign subsidiaries again the biggest question, because I need to make them closing the books for the purpose of determining my fair valuation, etc. So another big aspect here is also the value of the investee company should be considered on a pre-tax or a post-tax basis, because ideally the investor is entitled to realize his investments only after spending now. Of course, we have the TDS. Hence, imputing full value of investee company may result in again double taxation also. Some reference circulars, etc., which was wanted to place it before you to give a overall study. Again, 156(2)(7)(a) and 52(10) of the income tax on fresh issue and buyback of shares. The CBDT has issued circular number 10/2018, dated 31/12, to clarify that provisions of 56(2)(7)(a) of the tax, being anti-abuse provision, shall not apply in case of receipt of shares by a specific company or firm as a result of fresh issuance of shares, including by way of bonus, rights, and preference shares. However, on reconsideration, it was observed by CBDT that the matter relating to interpretation of the term receives used in 56(2)(7)(a) of the Act is pending before judicial stakeholders have sought various clarification. Accordingly, with the idea of issuing a fresh comprehensive circular, they have withdrawn the earlier circular, and we may also have to refer a new circular where many issues have been clarified. In order to prevent the practice of transferring unlisted shares at price much below their market value, it is proposed to amend 56(2). That's the background of the 56(2). But today, one challenging part or one loophole which was still available, meaning is in case where, because they are saying while doing the fair valuation, you need to do the fair valuation of the shares. One of the A plus B plus C plus D is concerned. While it says A is the book value other than B, C, and D, and only the fair value of immovable property should be done, fair value of jewelry should be done, an artistic thing, fair value of the shares and securities should be done. So, but they are not talking about investment in a partnership. For example, consider this example, ABC Private Limited, which is a partner in a partnership firm, because a company can be a partner in a firm, and that partnership firm is holding an immovable property. So I need not have to do a fair valuation of this 1 crore investment in a firm. Technically, if we go as per the book value, because it is a firm, it is. They are not today talking about you need to do a fair valuation of a firm's investment in the interest of a firm. Also, they are only talking about shares. So as per the definition of the term share, it is not taken account. But on a wide note, so the term share is not defined in Income Tax Act, hence will be taken from Companies Act where the share is defined, a share and share capital of the company. Its fair valuation is not applicable with respect to gains from transfer of an interest in a partnership firm. The property of such entities consists directly or indirectly of an immovable property. So this loophole is there. Again, the department will do something to again plug the loophole of this particular transaction, right? So these are all some broad critical challenges. So 10 minutes are there, therefore maybe I will stop here, and then probably if there are any questions, we'll take it up in the next 10 minutes.
Members are requested to make a few messages through questions to chat box, shall we?
If immovable property is invested in a firm as capital, capital under Section 40 is applicable. Section 50 CV applied here on transfer of the immovable property. Technically speaking, it is not. 50C will not be applicable. Just like this particular loophole which I just now presented here, even for the purpose of the any indirect method. So it should not be very big. This is what my view is.
Members are requested to raise your query through chat box or raise your hand. I will unmute you. Any questions? Any questions? Members are requested to put a chat box or raise your hands. Definitely, sir. We will share our presentation through our official mail ID. No issue at all, sir.
Yeah, I will share the complete PPT along with all the details of the case laws also, which I have referred here. That also.
Thank you, sir. Thank you. Thank you. Also, this is this program will be hosted in YouTube channel. So if you want, you may view through YouTube channel. Our Erode branch of SASF ICAI. This is our Erode ICAI is our YouTube channel. So kindly recollect or review our today's meeting. No issue at all, sir.
Fabulous. I think you may circulate the material, and I think that's, yeah.
Yeah. This is a link of our YouTube channel.
So I thank the management and Erode for giving me this good opportunity, and also I would request the members to maybe using you can send a WhatsApp or maybe an email in case of any practical difficulties and when challenges where we can discuss and debate on some issues which we discussed. We can always send an email to me. Thank you.
Thank you, sir.
For giving this good opportunity.
Thank you,
to me.
sir. Thank you. Thank you, sir. I herewith request our treasurer to deliver the vote of thanks. Treasurer, sir, kindly unmute yourself.
Thank you, Chairman. Chairman, is it audible?
Yes, sir. It's audible, sir. Please.
Yeah, thank you, Chairman. We at the Erode branch of SIRC of ICAI express our appreciation to our today's faculty for a detailed insight into the valuation of unquoted shares. Thank you, sir. We hope that our members would have perceived the various complications and solutions in the valuation of shares in private limited company in relation to various statutes, particularly the Income Tax Act. So we also thank all the participants in this session. Thank you for your participation. Over to our chairman for adjournment of this meeting. Over to you, chairman.
Thank you, sir. Thank you, sir. Thank you. Thank you for your valuable. Once again, I will thank to our today's faculty, Sundar Raman, sir, for dedicating their valuable times. Once again, thank to all the members to participate in this VCM, the virtual CPE meeting. Thank you. Thank you all. Meeting is adjourned.